Hey traders, this is Christian Fromhart, CEO of Tribeca Trade Group with your weekend video, getting you ready for the trading week for next week. I'm going to start the video off a little bit differently this week. We'll talk about the past, what happened last week as just kind of a quick review, and I have up ETF fund flows, which really give me a good sense of where money is being allocated into this market. I spent some time on this about a week ago. I was talking about, I was disproving a lot of people who were talking about monster inflows into equity ETFs and they thought it was a top. This was basically a week ago, it was quadruple witching. This just happens every week. This happens almost every quadruple witching where there's a heightened amount of flows just for that week. So what did we see last week? We saw $4.9 billion of outflows last week. Most of that was some of the ETFs that drove up the $13.6 billion. So that mostly happened in the beginning of the week. And ETFs that I mentioned that kind of caused some of this, straight inflows and then straight outflows, which again is just part of the rebalance of usually what happens. Dealers close positions in some of these ETFs that they have open, and then they reopen them in terms of exposure. They don't want to handle the rebalance. So some of these things like IVV, VO, VTI, VUG, you look at the 2 weeks together net flows, and it's basically flat. So there's up and downs because of that. So that's what happened last week in the major ETFs, in the major index ETFs for a whole in the U.S. $4.9 billion out of equities. But again, netting the two, and overall it's a net increase. Really, the story of the week, I would say a couple stories last week, but the major story was biotech. Look at the healthcare, look at the money going into healthcare ETFs last week. $2 billion. That is really unusual. That is not something that you see every week. Normally it's, for biotech or healthcare, it's a couple $100 million up or down, depending if somebody's going in or kind of taking off some risk in this space. But $2 billion. And I apologize, I don't have the exact number, but I would say that's the biggest inflow that I've ever seen in 1 week going into healthcare and biotech. I don't think I've ever seen $2 billion going in there. I can show you some charts that will actually show that too, but take my word for it, $2 billion in 1 week in ETFs has never been done before in healthcare and biotech. So what were the ETFs that made that up? A lot of it was IBB, $962 million. So that was about half of the inflows for the week. And then also you could see a number of other ETFs, and this is what I really like when we see money that was being either added or taken away to kind of give you a signal, because you could see, for example, I've got XLF, which had the biggest outflow last week, and it was just one ETF. It was XLF. This week in healthcare and biotech, it was a number, so it's a lot bigger than just one player going into the market. Obviously, when you see inflows into not only IBB but XLV, XBI, IRY, which is international healthcare, IHI, which is medical devices, IYH, and VHT, all seeing inflows above $50 million for the week. It's more than one party that's doing it. And the breadth, just like sometimes people analyze market breadth in terms of stocks that are going up and stocks going down, when you have 5 or 6 ETFs that all are seeing inflows, there's something greater than going on than just one player coming out of the market, like we saw last week in financials, where it was basically just XLF drove the whole thing. So it becomes, for me, a bigger indicator when we see more, a lot of ETFs in a particular group seeing inflows. So that's I know where I want to go next with this, which is international ETFs. But let me just finish up with the U.S. groups. There are some interest rate sectors which I think makes makes sense. I don't know if it makes perfect sense, but it makes sense that some of these areas like REITs and utilities are seeing inflows, because if you look at what has happened in the 10-year bond in the last month or last 2 months, it's gone from yielding 2.4 to 2.1. This is almost like a rubber band that gets stretched. When yields get high or go higher, what happens is people move money right away into treasuries and out of defensive or higher yielding equities, because the risk profile is just better for, there's less risk obviously in government bonds than there is in owning stocks, even if they're utilities and REITs. So that usually kind of, it's a push and pull type thing. So when rates go high, money comes out of these areas. When rates go back low, like they have been trickling lower, 2.14, and we could look at a chart of TLT and you can kind of see what I mean. You could see that since we've crossed over the 200-day moving average, it's generally has been grinding higher here. You could actually see there's a golden cross in TLT. So the 50-day moving average moving above the 200, and a great thing to kind of, to have in your portfolio for diversification is maybe a long in treasuries right here, as long as they're, I think, above the 200-day moving average. The other thing that I notice here in the TLT chart is you had a nice retest as well. So you had a break above, and I'll zoom in here a little bit so I'm not just looking at the side of the screen, but you had a break above the 200-day moving average. You almost had a retest. It didn't get exactly down to the 200, but then, so a nice retest and a move higher here. So I don't think a little bit of exposure to bonds here is the worst case scenario, but just kind of goes back into my thought here about why there's money going into REITs and utilities, because those become more valuable once treasury yields go down, which is what they're doing. We already talked about the financials outflows, so that kind of covers the U.S. sector portion. In terms of international ETFs, so just like I was talking about a lot of breadth in healthcare and biotech inflows, it's been the same thing with international developed areas of the market. So again, mostly, when you talk about developed areas of the market, it's mainly Europe and Japan. So they continue to attract a lot of money. So last week it was another $2.4 billion going into these ETFs. This is, again, not just one ETF. It's EFA, VEA, and IEFA. They all captured. Well, the EFA made up $1.1 billion of it, but these still healthy inflows, over $400 million last week. So people still are in this theme of, purchasing, I could come up with my own reason. I would say maybe it's a catch-up trade. It's also the growth is starting to pick up a little bit, I think, in these areas. So, this has been the trend over the last couple months. It's generally been a lot of money that's been being put to work in international developed markets. Same thing with European ETFs. This is getting to be like a broken record now here for the last couple months. Another $1.1 billion being put to work in Europe. So it's been pretty consistent now over the last few weeks. It was $930 million last week, and it was $1.7 billion the week before that. So people are still, big funds are still putting money to work in Europe. And again, it's good breadth. I mean, it's not just one ETF. It's EZU, it's FXE, which is the Euro ETF, which I'm going to talk about in a minute. HEDJ, VGK, DFE, which is small cap European, and Fez. They're all seeing they all saw inflows last week. So again, not just one particular ETF. And then finally, fixed income. There were some flows into some treasury ETFs, also a couple other areas of the market. One area that always sees outflows when we see crude fall, which is what we obviously saw last week, you always see, or typically, I don't want to say always, but you typically see outflows in the high yield bond space. It's almost like the weak hands. As soon as crude starts going down, the weak hands get shaken out of any big high yield bond positions very quickly. So I have a chart of that. I put that out last week, just watching what happens when crude goes down. People yank money out of these high yield funds. Usually once crude stabilizes and starts to go up again, then people throw money back in to high yield bonds. And it's kind of funny because it doesn't have as much money as you would think it is, as I try to bring up this chart here. If you go into HYG and you look at how much energy exposure, it is, oil and gas is about 8%. So it's not like it's 20, the amount of money that gets taken out of these funds when oil goes down. I would think my guess off the top of my head would be, there's 20 or 30% exposure to energy, oil and gas names in HYG, and it's not. It's 8%. It's only 8%. So it's still significant, but it's 8. It is what it is. It's 8%. It's not 25%. So, but anyway, that's the last point I wanted to make on flows. I spent a little bit more time than I than I usually did, but there's some interesting things going on. So really, what I want to talk about is what kind of a market is it? Right now. So we talked about biotech, seeing those inflows. Biotech was up 10% last week. Solar names were also up a huge clip last week. They were up, I think I have them up here someplace. They were up 7.7% last week. And then you go and you look at what SPY did for last week. It was basically flat for last week. And in fact, since the beginning of June, the SPX hasn't really gone anywhere at all. So you always want to look at what type of market you're in. You always want to go where the opportunities are. And I've talked about this many times, but you want to trade, or you want to be involved in where you have an edge, where there's alpha in this market. Where the alpha is right now in this market is stock picking. This is pretty simple. I'm not making a huge leap of faith here, but looking at what happened in these groups last week, the solar names and biotech moving 10%, and then sitting in S&P. So I get these advertisements. I'm sure you get these advertisements if you're a regular trader and you happen to attend something, and all of a sudden you're on these distributions. I get them every week, like how to make money in S&P futures, how to trade S&P futures. Let me tell you the secret, because I just got another email saying the secret of trading S&P futures. Here's the secret. S&P futures are used as a hedge by but for the majority of institutional investors. They're not used to generate alpha. So, I'm sorry to kind of break the news, but this is not where the alpha is generated. Now, if the market changes and we see a lot of volatility where the VIX goes up to 15, 20, 25, and the S&P and the indices are moving quickly, and the correlations are very high, meaning all stocks are moving together, I will put my index hat on and I will start trading S&P futures. I'll start trading Russell futures. I'll start trading NASDAQ futures a lot more. I did that a little bit when we had a little bit of volatility a couple weeks ago in the Qs. I was trading more Qs because all the technology stocks were moving together. So right now, the VIX is back to 10. I don't know how long it's going to stay at 10. I think it's a little bit low right now. Probably, I don't want to say probably, but I would imagine at some point we'll get a little bit more volatility and the VIX gets back up to a 12, and so on and so forth. But for right now, we've got some stocks that are moving up, just like we mentioned, the solar and biotech, and we've got some stocks that are moving down. Stocks that are moving down are energy and retail currently. Now, that might change next week, but those stocks are in downtrends right now. So that's basically why the S&P is flat. You've got a lot of cross currents back and forth between sectors. So to me, it makes a lot more sense to follow the uptrends and follow what names are going in downtrends. You don't necessarily have to short those names that are in downtrends, but you can avoid them. You cannot go long them. So that's really what I'm concentrating on. And, in terms of last week, so my conclusion here is, listen, just like with any trend, no one ever knows how long a trend will last, right? But you want to be in that trend while it's moving. So right now, I want to be in the stock picking wave and continue to be there. That's where I've been all year long. That's how I've been beating the S&P this year in my performance. So I want to stick with that theme until the market tells me otherwise, until price really tells me otherwise, and things change and volatility starts to move up. Then I will change my stance. Until then, I'm staying the course with stock picking. Just looking, and I'm only naming a few last week, but these are names that we saw aggressive call activity last week. And I'm not going to tell you the performance of each one of these. You could go and you could look at the chart of AMD, US Steel, CSIQ, First Solar, MNK, MDRX, Gilead, XBI. These were all names LXRX. And again, this is just a handful of the names that we saw call activity last week, which were outsized profits. A lot of these names, most of these names, we actually played in the trading room last week. So what I want to say here, just to kind of conclude, is obviously we can't take every trade that we see aggressive call activity in, and not every trade is going to work. It's just how it is. So what you want to do is wait for your pitch. Wait until, just because there's aggressive call activity, really doesn't mean much. In the fact that, hey, it might meet your, somebody's buying, and it might meet your trading system. We've seen a hell of a lot of option activity, aggressive call activity in energy names, right? I mean, these things I've avoided because they don't fit my trading system. So you have to wait for your pitch where it lines up. And you want to swing consistently, just because you really like the pitch. The good hitters in baseball, you don't necessarily, well, maybe a couple times you see them swinging a little bit harder, but it's a very consistent swing. So you want to wait until the for the pitch that lines up, and the trade that works in your trading system, because it's worked very well, and that's why I'm spending time on it this afternoon, is because you could hear in my voice, we've just had really some big outside returns by playing this way and making sure that the trade fits our system, looks good technically, is in an upswing, is in in an uptrend. Where we've really made a lot of money is pullbacks in uptrends, where all of a sudden call buyers come in. So that's a little bit of a secret that I'm sharing with you, but it's worked extremely well. And even by telling someone that's a great way to make money, you still have to be disciplined and take only those types of trades that fit your system, and not take too many positions on. So in regards to not taking every trade, I think it's important here, going back to where the VIX is right now. I generally like to take more positions on and more risk after we've had those pullbacks into support, which we had a couple weeks ago in the Qs and in technology. We talked about that in great detail about why I thought there was a pullback in these groups. There was a big S&P rebalance. It was not just one thing, but it was a combination of things, right? I mean, these stocks were really heavily overbought, and something like an S&P rebalance, where tech was heavy to sell for the S&P 2 weeks ago, people are going to pile on once they see people starting to run. As soon as there's selling pressure on something that's overbought, people are going to get out quickly, which is what we saw a couple weeks ago. However, that made for a great buying opportunity. So right now with the VIX, the VIX got under 10 on Friday. It did get back above. I think it closed at 10.03. So this is a place generally where I still think things can go higher. So I want to stay in my positions. But I don't want to put on a crazy number of positions while the VIX is around a 10. I think we're going to get another chance. I don't know when that's going to happen. I don't know what's going to cause it, but I want to have some cash on the sidelines for when the VIX does get up to 12 or 13, and then to start to take a look at some of these positions that have gotten sold off when that happens, and redeploy. It's a rinse and repeat type thing here, and so that's what I did a little bit on Friday. I kind of forced myself out of a couple positions just to kind of lean down a little bit and just prune and stay in the ones that I want to be in. So this video is just going to be about some macro trends, which I'm already 17 minutes in. It's going to be about some macro charts and some sector charts. I will be doing a webinar on Monday, which is tomorrow at 1 o'clock, and I'm going to go over some single names. But just to kind of finish out here, this first page here, in the Qs, I see a couple things here, a couple areas where you can be long against, where I like it. So you got support 1. And I'll actually show you here on this chart, so it's a little bit larger here. But you could see, two things that jump out at me is that, well, three things, right? I'll get to the third thing in just a second. But one, we briefly dipped into this value area. We came back out last week, and I think the Qs were up 2.3 or 2.4% last week. So we had some nice. Some grinding price action here. We had a couple days of the week where Qs really went. So we had some nice volatility here in the Qs up and down. You could see these big bodies of candles, but we are moving in the right direction here. So first level of support is this gray line. Why I've got that drawn is because that is what the open from where we were about a week ago, 614. So as long as we're above that level, you've got that nice defined support right around 141. So I would want to stay long. Not just the Qs, but kind of technology names and names that are in the Qs. versus kind of looking at that support in the Qs. So that's support level 1. Support level 2 is if we do get a down day in the beginning of next week, or somewhere at the beginning of next week. Your second area of support is right at 139, and that would be an area that I would also probably add to longs, provided that we hold the support. If we start breaking this level and get down to the 50-day moving average, I would want to wait to see if it holds. And maybe wait to see if the 50-day held like it did here, which was really nicely. Every time we touched it, we bounced. Not huge. It kind of took a little patience to kind of see this through, but we did end up higher. And then the last thing I'll say is watch for an MACD crossover for confirmation. We have not had that yet, but it looks like we could get that in a day or two if we continue to go up and to the right. So that is Qs, and the reason why I spent some time on the Qs is because there's a lot of charts that there's a lot of tech charts that kind of look the same. Like look at Google. Google very similar. I'm just pulling names out of a hat here, but maybe ATVI is a little bit different. But there's a couple different ones. I think Amazon's a little bit different, but I went through about 5 or 6 charts in the space, and they look very similar to basically what the Q's pattern is. Not exactly 100%, but close to it. All right, so we covered a lot so far. I'm going to talk about charts. So I mentioned in the ETF section, or I mentioned the inflows into biotech and healthcare. One name that caught my attention or caught my eye that I have not seen in a long time is IRY. This is international healthcare. So it's names like Novartis, Roche, what's this one? SNY, Sanofi, GlaxoSmithKline, AstraZeneca, Shire. Look at the volume in this thing on Friday, and then I've got below that, in case you're not familiar with what this is on the bottom of the screen. This is fun. This is graphically, which I love. Bloomberg does this now. They show you the fund flows. So fund flows will happen either a day or two after. As dealers create because of the demand, the buying demand, to offset that, and it's how they make markets on it for a big order. I used to do this, so I'm very familiar with the process. So you could see that the inflow confirms that this big candle in volume. I mean, look at this thing. There's no volume in this. Again, how does a market maker do this? They access the liquidity by buying this underlying basket. And then what they do is they do a creation with the fund, which collapses their long short position. Again, they sell the ETF because all in all, the investor wants to own the ETF, and they source the liquidity to make to provide that investor with, by being able to put on a sizable position. They access the liquidity. They buy the underlying basket. So that's what an inflow is. They're basically then the market maker sits with a long of the underlying basket, and they sit with a short of the ETF. They need to collapse that position, so they call up. I think IRY. This is State Street, the State Street product. So they call up State Street and say, "Hey, I need to do a creation," and they send their position over to collapse it, and there you go. And then you see an inflow a couple days later in the ETF. So nevertheless, there's nice buying pressure. It is pretty extended, as all biotechs are probably a little bit extended. So let's see if we get a little bit of a pullback next week to kind of get involved there. But definitely, I'm keeping that name on my radar. Also, I mentioned I would talk about the euro. I have to check to see that this is not an anomaly in FXE, but real nice inflow right on Friday, $135 million. You could see, again, same type of chart. You could see this big inflow on Friday. So sometimes these things, I like to wait a couple days just so that somebody didn't make a mistake here with an inflow, but it looks like somebody's going into the euro. Taking a look at the technicals in the euro, notice that it's had a nice break of the 50-day of the 200-day moving average. You got a golden cross. You got the 50-day climbing above or crossing over the 200-day moving average, and you've got a lot of price digestion here over the last month. So it's the price has been letting the moving averages kind of catch up with it, and nice support here on the 50-day moving average. And I like a long here in the euro, and that inflow kind of tells me, again, I have to double check to make sure that that's going to stand, but somebody else apparently likes it too. There's a lot of money going into that on Friday. You can see a nice crossover here. This is a stochastic study, but you can see it looks like a nice buy signal developing here as well. EWJ, so Japan, a lot of inflows in Japan. Again, this is the fund flows over time, and you can see all these little green bars in here. And look at the volume. Somebody's been accumulating Japan. And if I look at this, so last week it had $474 million of inflows, which is nice. But if we look at this in terms of EWJ, this kind of looks like a nice pennant up here, a nice break higher in Japan. So that's why I'm kind of showing it on Thinkorswim. You could kind of see this pattern a little bit better, but you could see a nice, nice pull, I would say, of a flag or a pennant, and a little bit of a move down here. So we reached a high in EWJ, the Japan ETF, of about 54.90, and we're down to 54. So, I think this makes a nice place to kind of go long here, as long as the price holds this blue line. This is the 20-day moving average. So if it fails, and maybe the price goes down to the 50, but for now I think I want to try along here and see if the 20-day holds. Also, looking at a longer term chart, you could see that this is going back to 2006. The price just recently got outside of this resistance. So you could also try along versus that breakout zone right around, what is it? Looks like 52.71. It looks like, so about $1 or so down. That's your breakout from a long-term perspective. Okay, so now one trouble area that I see on my charts, XLY, consumer discretionary. So even though Amazon is the biggest weight in this ETF at 16%, you can see something's kind of going on here. We really haven't seen XLY, and if I bring up a Bloomberg chart, it might be a little bit more pronounced here. And if I zoom out, let me just go 5-year and then back to 1 year. So you could see that since November of 2016, the price has basically been above. We've touched it here a few different times, the 50-day moving average, this purple line, but it looks like it's getting a little bit iffy of breaking down here. So couple levels to watch here. I would watch 89.32. That's the bottom of value areas. So I look at moving averages and I look at value areas for support and resistance. So 89.32 is your bogey in XLY. And it kind of makes you think about, what if Amazon wasn't the biggest weight in XLY, or maybe was just a regular weight, or maybe not even in it. So you can look at, there is an equally weighted consumer discretionary ETF. I just went ahead and looked at XRT, which is not exactly consumer discretionary, but it's retail, and every name gets the same weight. It's equally weighted, so there is no name that is dominating this, and it's really astounding. And I know that this analysis has been done before, but it's still startling to kind of look at this sense. I looked at is this a 5-year chart? I think it's actually 3 years that I put together. Yeah, 2014 to 2017. The white line is Amazon, and the orange line is XRT. XRT has done nothing over the last 3 years, and look at what Amazon has done. We know this, right? I mean, we know Amazon has been a huge outperformer, but it's just crazy to me when you put the actual figures behind it. Amazon is up 208% in 3 years versus XRT down 4.7%. So, it tells you that in this, going back to this XLY chart, if you took Amazon out of this ETF, it would probably have already been broken down pretty decently here. When you start to look at some of these individual names, even the strong names, the stronger names outside of Amazon. Look at what happened to Home Depot on Friday. Now, there was a Russell rebalance that happened on Friday. It's not just small caps that gets rebalanced. There's a Russell 1000 fund that is large cap. So keep that in mind. We saw a lot of crazy big red bars when the S&P rebalanced. Keep an eye on this one. It broke the 50-day moving average. Let's see if that was just, and on big volume. But let's see if it comes back here. Or let's see if this is actually fully breaking down. The price action tells me that it certainly broke the 50-day moving average. Maybe something to look at here. I don't have the 100-day on here, but you could see that we're getting close to that green line, which is the 100-day moving average. That might be something to take note of. Maybe also this dotted line, which is kind of the peak here. So that's a name that I'm watching. Considering that a lot of these names, people are shooting first and looking later. Costco is one of those names that is broken below the 200-day moving average when you factor in a dividend-looking chart. So these names have been taken out, even though this deal hasn't officially, it's not approved or anything like that, but people have been shooting first and looking later. And I think Costco is a good example of that. I kind of understand that one, right? They're in the same business. Home Depot is not. I mean, unless Amazon is going to get into the home improvement, and you can't really. It's going to be some time before you can go to an Amazon store and pick up plywood. So Home Depot is one name that I've got an eye on. I'm not going to jump into it yet. I'm going to wait for a signal. Maybe that signal is to hold that 100-day moving average. So that's something that I'm looking at for next week, or a name at least I have an eye on. I mentioned I wasn't going to talk about too many single names, so that's about it, because I am going to be talking about that on Monday. And then industrials. This one caught my eye as a possible long. It did hit a 52-week high last week of 69.19, and then it kind of fell apart a little bit last week, but it kind of fell into support. So I want to see if, I'm watching for it basically to retake this yellow line, which is the 5-day moving average. And I think I've got one more chart in here, and then that's it. This is a longer video than normal, so thanks for hanging in there. But you could see that this is KBA. I'm long ASHR, which is a very similar ETF. But the reason why I'm showing this one, KBA, it's essentially, not essentially, but it's very similar to ASHR. This is local China A shares. This was the announcement that we saw last week from MSCI that they're going to be including local shares. Again, not FXI. I'm not going to go over that again, but this is nothing to do with FXI or Alibaba or JD.com, names like that. This is local Chinese shares, so A shares, names that are not that don't have ADRs, names that are on the local Chinese exchange. So the reason why I'm showing KBA, which is about half the size as ASHR, is look at all the money that's been going into here. Look at the volume in the last couple months. This to me is confirming this breakout. And again, this ETF is tiny compared to the overall Chinese market, but someone's doing some buying here, and especially on this break. So I've talked about the false breakouts in this ETF before. If we go to a 5-year chart in ASHR, I don't know if that KBA ETF has been around that long, but obviously this was the big speculation a couple years ago in China once they allowed outside investors into local Chinese shares, and then once the government put some controls in place, it came back down as fast as it went up. But it's been having this long base here, and if we zoom into a 1-year chart, you could see that it's been basing, and it's had a couple times where it started to get go and kind of a false breakout. I got long this ASHR ETF on this break once we cleared this level. So I've been sitting in it. I think on this candle, I got long. So I've been sitting with it. It retested back at the breakout zone, and it's been going up here. This looks different to me. This volume on this break looks different than the volume here and in here. No volume at all in this ETF. Look at the volume here and the inflows. So could tell me that this trend has some rallies in it. I don't want to make a prediction here because that's not what, making predictions are, everybody's got predictions, right? I'm just following price action, and I'll stay long as the trend is up. So that's it for today's video. Thank you very much. And then catch our webinar tomorrow. That's I just tweeted that out. So my handle is at @CFromhertz, and you can find the registration link. Monday, 1 o'clock, we're going to be talking about single names. Again, generally how I look at the market is I look for the trends in sectors and areas around the world, and then I drill into single stocks, and I look at aggressive call activity. So we're going to be discussing that Monday afternoon. Thanks for watching. Enjoy the rest of your weekend.